Good afternoon, ladies and gentlemen. Welcome to today's event, Intermarket Analysis, Charting Second Half Trend and Direction. It is a great honor and pleasure to have you all here with us. First, allow me to introduce myself. My name is Camilla. I'm a Senior Tax Manager at KPMG Indonesia. I provide tax advisories, tax compliance, and tax due diligence services. I focus on financial industry. Okay, before that, I used to work as a Vice President Tax Risk Management at HSBC Indonesia. And I'm also an ACCA student, an ACCA candidate. First of all, I would like to extend a warm welcome to our distinguished guest, Mr. Pahala Nugraha Mansuri, CFA, President of CFA Society Indonesia, Mr. Edwin Michael Ridwan, CFA, Investment Director of BP Jam Sostek, and Board Member of CFA Society Indonesia, Mr. Wong Kon Hao of CME Group, Mr. Johannes Nugraha, SE, SFCCA, Group Finance Director of GSK, Mr. Andrew Lim, Portfolio Head, ACCA Maritime Southeast Asia, and all of the board member of CFA Society Indonesia. Thank you for being here and for contributing to today's event. This event is designed as a collaborative platform where innovation meets insight and ideas transform into actions. To officially open our conference, Mr. Pahala Nugraha Mansuri, CFA. Let me briefly introduce Mr. Pahala. Mr. Pahala Nugraha Mansuri, CFA, is the President of CFA Society Indonesia. Mr. Pahala has taken many important roles. Previously, Mr. Pahala has served as Vice Minister of Foreign Affairs, Vice Minister of BUMN1, President Director of BTN, Director of Finance PT Pertamina Persero, President Director of PT Garuda Indonesia Persero Tbk, and Director of Treasury and Market of Bank Mandiri Persero Tbk. Mr. Pahala holds a master's degree from a Leonard Stern School of Business. Okay, please, Mr. Pahala.
Thank you. A very good afternoon and welcome to all of the participants. And also we would like to acknowledge the continuing support of CME Group that made this conference today possible. CME Group has over the years support and provide us with excellent regional speakers. This is the fourth annual market conference titled Intermarket Analysis, Charting the Second Half Trend and Direction. This year, we partner with ACCA Indonesia to cement and also strengthen the global relationship that CFA Institute has already initiated with ACCA. And also, we also, as you know, has created the Climate Finance Certification. We would also like to welcome Pa Edwin Ridwan, CFA, who is also our board member. And right now is the investment director of BP Jam Sostek, who will give the keynote speech of this conference. And we also welcome our speakers, Mr. Wong Kon Hao from CME Group, presenting his outlook on the global markets for the second half of 2025. Bapak Johannes Nugraha, chairman of ACCA Indonesia, who's also the member of the panel and CFO of Gunung Sewu, who's going to present his view and also titled The Weathering the Storm, Building Resilience Against Climate Disruptions. We also would like to welcome and thank our panelists today, Pak Ray Laksana, CFA, CEO of DBS Vickers Securitas Indonesia, and also Tommy Zhu, CFA, the director of Agrodana Futures, who will present and discuss about fixed income, equity, and derivative market in Indonesia and their respective outlook for the second half of 2025. And we would also welcome the honorable invitees from our partner association, corporates, as well as university. Last but not least, CFA Society members, CFA candidates, and general public audience. Without your participation, the conference will not actually be able to be organized today. I think one of the things that CFA has been championing that CFA would like to continue to develop the capital markets in Indonesia, particularly the development of the capital market professionals. And I think we would like to continue to be able to develop the Indonesian professionals in the future. Ladies and gentlemen, right now we are seeing that geopolitical tensions, the climate change, as well as technological change has all very much affecting the global markets. Geopolitical tensions, for example, including the most recent trade and tariff wars, is expected to be the ongoing trend that will affect the global markets. And therefore, we expect that the volatility and uncertainty will continue to become the norm rather than the exceptions in the future. So the ability for us to navigate and understand about what is exactly going to be the trend going forward is really something that we hope all of the speakers, including the keynote, other speakers, as well as this panel, are going to be able to continue to actually support us. I think the second thing, we also welcome the perspective from Johannes Nugroho about the building resilience against climate, because climate is also one of the second topic that will continue to become more and more relevant for all of us. This is actually going to be one of the key challenges and one of the most relevant issues going forward, despite the shift in the position that the US government and the US current administration is taking about the climate issues. We believe that all of these climate issues continue to be one of the topics, and also how would all of that also affect other commodities, including critical minerals, because we understand that the demand of the critical minerals obviously will continue to actually increase as climate issues, as we know the shift from fossil fuel to renewable energy will also shift the demand from oil and gas to other critical minerals. So again, all of this perspective that we are going to hear from both Pak Konho and also from Pak Nugroho will be very, very relevant for us to understand what is actually going to be the short-term effect of all of these issues that we are currently facing, as well as the medium-term, as well as the longer-term perspective about how would all those going to affect our investment decisions. Let alone, we also talk during lunch about the effect of technology. We understand that right now AI and crypto are the two of the relevant topics within the technology that will also affect how not only we are going to make our investment decisions, but also possibly how are we going to be able to allocate and change the asset allocation going forward. Ladies and gentlemen, we would like to thank all of you, and especially the volunteers from Indonesia Women in Finance. IWF is an integral part of CFA Society in Indonesia, whose mission is to promote financial literacy as well as encouraging the participation of women in finance and investment. Again, thank you to all of the speakers, all of the participations from all of the audience, and we hope that you are going to be able to enjoy and get a lot of insights from today's discussion. Thank you.
Thank you, Mr. Pahala, for very inspiring opening remarks. Next, we will request our next keynote speech by Mr. Edwin Ridwan, CFA. Mr. Edwin Ridwan, CFA FRMM, is the Investment Director from BP Jam Sostek. Before joining Jam Sostek, Mr. Edwin was the Head of Investment of PT Taspen and Chief Investment Officer at Agrodana Investment Management and Associate Director at Bahana Sekuritas. Please welcome Mr. Edwin.
Good afternoon, ladies and gentlemen. Yang saya hormati Pak Pahala, all the speakers, and everyone attending this event. Okay, so in this event, our topic will be the intermarket analysis of investments in 2025. Of course, we are all anticipating the second half, where the trend is going to go and also the direction of the market. Okay, this is a bit of my background. So as we all know that the current situation in the world is creating a lot of volatilities, and 2025 has shown us that the dynamics in global financial markets is very lively, to say the least. Of course, the intermarket analysis will be more important in this time of uncertainties. So I think the main reason why we are having a very challenging market condition is because of this one guy, Mr. Trump. With his presidency, I think he has shown in his first administration that he's here to shake the market, and I think he has done so also in his second term. There's an event called Liberation Day, if we all remember, in April, I think, as the 2nd of April. Mr. Trump announced a very, how do you call it? He's shaking the market, just to say the least, yeah. And on that Liberation Day, we saw markets all over the world tank. For example, S&P 500 sold off 4.8%, erasing 2.4 trillion market cap just in one day. And also, international equities didn't fare much better. So we saw Europe stocks fell 3.6%, and Hang Seng went down 1.5%. Also, the Japanese topics went down 3.1%. And we saw, because of the introduction of unpopular policies from the US, as the effect is, we see a sign of foreign investors or global investors losing faith in the US dollars. I think this last thing is the most important thing for us, especially in Indonesia. I will show you why later. This is the same charts that shows that because of the tariffs introduced by US, it shakes up a lot of markets, not only stock market, but also on the currency and also gold. We saw gold hitting all-time high to 3,500, is it? So, of course, gold has gone down a bit right now, 3,200 or so, but I think it's still very high from a historical perspective. So the main thing that is very interesting for us at PP Jam Sostek is the new trend that is developing, which is the sell everything American, because that has a very profound effect, because US dollars is very dominant currency in this global market and has become like the go-to market, the go-to currency whenever we see imbalances or the global market shaking up. And we saw just a few days ago, Moody's has downgraded US credit rating, and because of that, the 30-year bond in US, the yield has hit about 5% or so. And this has also weakened the US dollars even further. We saw Indonesian stock market is very resilient. Because of the sell-off, we also suffered the sell-off, but I think we have went up about 20% from the lowest point around early April after a long holiday. I think 8 April also, when the market opens, of course, we saw the Indonesian stock market went down a lot, but since then, the market has recovered quite sharply. Right now, I think about 20% we are already up from the bottom. So one thing that we are very interested in is the movement of the dollar index, because from our research we see that DXY, or the US dollar index, has very high correlation with the Indonesian economy and also on the direction of the equity market in Indonesia. Like, for example, if we see from the chart from February 1985 to 1989, when the DXY, or the US dollar index, went down 62%, Indonesian stock market actually went up 5 times, 522%. It was a very good time to buy stocks at that time. And during 1989 until 2001, we see DXY went up 19%, and our stock market actually went through a very deep sell-off because of the crisis, the financial crisis that we suffered during 97, 98. Of course, if we see from the period of 1989 until 2001, market has recovered a bit, but still down 9% during those period. And 2002 until 2008, the Indonesian stock market actually went up a lot, like almost 5 times, when the DXY, or the US dollar index, went down 45%, and so on. So I think the key message here is, if we have to choose one factor that is very highly correlated with the direction of the Indonesian stock market, that will be the US dollar index. So because we see there is a movement of sell everything America and weakening of US dollars, I think this is the best time for us to buy into Indonesian stocks. That's our view in BP Jam Sostek. We even went out in the first day of the opening of the stock market after long holiday, the April 8th. I went out and say that we at BP Jam Sostek, we are ready to increase our allocation to stocks from currently about less than 10% of the total AUM to become 20% of the AUM in the next 2 or 3 years. But looking at the performance of the stock market, I think it will be shorter. I mean, we will be buying in the next 1 or 2 years instead of 2 or 3 years, because we don't want to be losing momentum also. So we have a very positive view on the Indonesian stock market in the next 3 years. Not because Indonesia is immune to the global uncertainties, but I think the thing going forward that is going to be in the investors' mind is because all economies in the world will be slowing down compared to the last 10 years. I think people will buy value right now instead of buying growth, because every economy is not growing anyway. So I think investors will look at economies that is least affected, or because Indonesia, we can still grow above 4%, I think, even with the tariffs. So I think we are actually in a very good position compared to other economies. Of course, our positive view on the Indonesian stock market is on a very long period, like 3 years' time. And during those time, we may see a lot of ups and downs and volatilities. It's not going to be a straight line going up, but we at BP Jam Sostek, we are very positive on the performance of the Indonesian stock market going forward, because of all the things that I've mentioned just before. I think there's a lot of discussion among foreign investors about the uncertainties of the current administration's economic policies. I think if the government is doing a very good policy making, we can grow in terms of return in stock market multiples, like 3 times than if the government is not doing very good policy making. But still, I think whatever happen, we're going to see Indonesian stock market outperform all other markets at this point, including also the emerging market, because for the last 10 years, emerging market has been shunned out by the foreign investors, and I think foreign investors or global investors will come back to emerging markets because of the things that I mentioned. So I think this is a golden opportunity for us, especially at BP Jam Sostek, to increase our equity exposure. Unfortunately, we are still not able to invest overseas. As you all know, that we are only able to invest domestically. And since about 4 or 5 years ago, we have cut down our exposure to equities and have bought a lot of government bonds, because during these 4 or 5 years, government bonds actually outperform equities. But going forward, at least in the next 3 years or 4 years, during Trump's administration, we are very positive on the performance of the equity market in Indonesia, and therefore we are going to increase our exposure to Indonesian equities from about 10% right now, double to 20%. And I'm going to give you some idea of the size of our fund. Right now we are managing about 45 billion US, about 825 trillion rupiah, and we are growing by 13 to 14% annually. So next year we will be managing about 1,000 trillion rupiah. So if we put 20% of that into stock market, that means we are going to have an exposure of around 200 trillion. Okay, I think that basically our message to the market. Of course, I have to say a disclaimer that this is not an investment advice, but this is our view from BP Jam Sostek going forward, that we are very positive on the outlook of the Indonesian stock market. Thank you very much. I hope you all have a very informative discussion today, and thank you for having me. Thank you.
Thank you, Mr. Edwin, for your valuable insight. It is very interesting to have a positive outlook about Indonesian economy. We would like to invite Mr. Pahala to present a token of appreciation. Next, we will hear from our first speaker, Mr. Wong Kon Hao from CME Group. He will discuss the market dynamics observed in 2024, where US stock markets, gold and Bitcoin posted significant gains, reflecting investor focus on inflation concern over the growth of potential AI. As we enter 2025, bonds started on a negative note, reinforcing the view that last year's focus on US stock, gold, Bitcoin as well-founded. In this session, Mr. Wong Kon Hao will examine the interconnection among these key markets to uncover valuable insights and develop effective trading strategies. Please, Mr. Wong Kon Hao.
Yes, first of all, I want to thank you, the MC, and I want to thank 2 very important people. If not, I wouldn't be here to have this opportunity to address or discuss about this topic. The first one is Park Rahmat. To me, is a very dear friend and very key person of CFA Society. Okay, the other second important man to me is my partner, CME Group, Mr. Harry Yeo. So thank you for having me. And also, it's such an honor to really, together with you, Park, Pahala N. Masuri, and also Park Edwin M. Ridwan. It's such an honor to be seated with you together side by side earlier. We have such a great discussion. And definitely with the rest of the panelists, the very distinguished panelists and speakers, and not forgetting all the those that are present today. It's such an honor to be here. Now, let's get started on my presentation. You know, to be here to share insights of what's happening is quite challenging right now, I believe, for even Park Edwin just now. Why? Because what we can prepare 2 weeks ago, it may not be relevant today. Things are so volatile and keep on changing. But I'm glad that when we designed this topic about the intermarket analysis, charting second half of the trend and direction, the team is making sense of the current chaos. And this topic was designed before the Liberation Day. And we knew that with President Trump, the world will be in chaos. So we have to design and look beyond what's going to be coming weeks or months. So we planned this topic that it could last us into the end of this year and perhaps beyond 2025. So this is what we have in mind. So this will be the key topic for today. And again, this is not investment advice. So what I'm going to share for the next 45 slides is honestly for my own consumption. Yeah, it's not for you to follow. So if you want to follow, it's at your own risk. Of course, there are some brokers around. Ray, from DBS Vickers Securitas, please look for him, or Tommy, please look for them. They are licensed broker over here. So at your own risk. And just want to share a wonderful news about the honor that I received last year in 2024 was being awarded as a Trading View Wizard. I do not know what is that, but on checking, I realized such an honor to have that from US, that I'm one of the 3 wizards that was being awarded in 2024. And in Asia, there's only 3. One from Turkey, I believe, the other one from Korea. And I hope that in Indonesia, we can have a Trading View Wizard as well this year or some years to come. Now, let's get started with the key topic here today. Which market has been moving up the most lately? Now, let me just give you a time frame, because this framework is important for us to understand, to discuss about the intermarket analysis. There's 2 main markets. Now, my question to you is, which market moved the most on the upward trend lately of the last 3 years? Let me be very specific. That means the last 3 years, this market has been almost continuously moving up. I think this answer is pretty straightforward. You may have already know the answer. It is gold, the last 3 years. That we could see that since, later I'm going to describe about June 2022, but it in fact started moving in March 2020. We're going to discuss why. This is important for us to understand what is going to be bring forth for the rest of the year, 2025, and even beyond that. Now, the next question is this. What is gold telling us when it moves up? Why? Why gold has been moving up since the year 2020? I think all of us will have a clear understanding. When gold starts to move up, it also represents that there's this perceived inflation may come. That was way back in 2020. Even today, that we could see since the year 2022, every year by now, the central banks around the world are the biggest investor in gold. Then you got to ask yourself, why are they investing in gold and accumulating in gold? Are they saying that inflation is going to continue on the upward trend? So later on, we'll discuss about, will this upward trend continue? It also means that, will this inflation continue? It's not just in Indonesia, but all over the world, which is very important to address this question, because once we have this answer, we will know that the continuous upward trend for gold is still there. Now, let me ask you the more challenging question here. Which market has been moving down the most lately? Let me just give you a time frame. The last 3 years. Any answer from the floor? Which market has been moving down the most almost consistently for the last 3 years? Now, let me just give you a hint from especially the year 2020, 2022, and from 2022 to current, all this 5 years, you have moved down by 44% continuously. Any clue? Oil? Okay, let's check it out. Is the US bonds. It's just amazing, isn't it? US bonds was one of the biggest market in the world before the US stock pickup. The largest cap, but not many people talk about it. If you look at in the same period where gold bottom and started to move up in March 2020, in the same month and same year in 2020, March, the bonds have peaked. And from this peak to the recent low, and that low was in 2023, and now it's still staying that low, it was down 44%. You know, since 2022, together with CME, we moved to places. We've been talking about the US bonds. But I noticed even in year 2022, not many people are taking notice that bonds is under pressure. It is only the last few weeks investors around the world start to pay attention to what's happening to the bonds. Especially on Sunday, that Moody's started to downgrade the US bonds to AA+. AA+ also means that bonds are on a neutral ground. They have no idea is it bullish or bearish. This is what they're trying to imply. Now, the next question is this, before we discuss about will the bond continue this downward pressure. So when bonds start to move down, what is it telling us? I won't ask you this question, but think about it. So I always be very inquisitive when market move in the extreme end. I got to ask myself, I hope you can do the same with your fund, ask yourself, what is the market telling us? To me, when the bonds start to move down to 44%, it is telling me that it is a trust issue, that the global investor are losing confidence and having the trust in the bonds. Now, we're going to address the next question here is, will this downward pressure continue? That's even more important. Okay? So this is the two main markets that we're going to discuss, and we're going to form a lot of opportunity moving forward. The gold and the bonds. I just want to take this opportunity to congrats CME Group. I think their think tank is just remarkable. They have this micro E-mini indices across in 2019. Somehow I just felt that their think tank are brilliant because when they birth off these products means they can hedge into the US indices. That's what it was in the year 2019 before COVID. Then 1 year later, or less than 1 year later, we have COVID and the stock market collapsed. So a lot of traders, hedgers, fund use this product to hedge into the US equity. And especially the option market, whenever I look at the option volume, it speaks to me the hedge activity has increased. Now, whenever the option volume pick up, it means that the fund houses are turning attention to hedging. Now, if you look at the S&P option average daily volume, you could see that in year 2022, the volume picked up tremendously. It also speaks to me that the fund houses are using option to hedge into uncertainty. Now, what happened to 2022? It was when US inflation hit a high of 9%. And during this period in year 2020, you could see that the volume also picked up. That was during COVID years. And even today in 2025, that the volume have picked up tremendously. What does it tell me? It tells me that the fund houses are hedging tremendously in this market. So we have to take note of that. Now, let's discuss about, earlier we discussed about what is gold telling us when it move up. That means they're seeing that central banks are seeing that inflation is still going to continue to stay on this high. But the question is that, will the gold continue to move up? I think that's the key question. We're going to discuss that. Let's look at the gold market. And in the midst of designing this presentation today, you know, it's always out of inspiration and passion that you have in the market. Things will always drop down as inspiration. I came up with this metrics to help myself. It's called a QTD. Now, Q, it means that is as long as quantitative easing is still there, in a time of uncertainty, the next crisis, I think gold will still go up. Then T stands for tariffs, the tariff trap. Do you think that the tariff will be ongoing? If the answer is yes, I think the gold will still go up. And the last one is the debt, the US debt. Do you think that the US debt is going to continue to climb? If the answer is yes, I think the gold will continue to go up. And that's became the trio. When the trio come into play, I think as an investor, we have certain confidence on where is the general trend of the gold market. Now let's look at the first Q, quantitative easing. That we can see that in history, of course, that's 1971 where the Nixon shock, where President Nixon announced that gold is no longer pegged to their US dollars. We saw it went up, but for the last 20 years, from 1980 to the year 2000, gold has been generally very stable at about 200 to 300 range. Now, the first QE in history, in the modern history, it was by the Japanese. That was in 2001. There we can see, of course, what is QE is we all knew that the central bank print money and buy their own treasury. So when that happened, gold started to move up. And it was a very successful campaign because it was first in history. And US studied that. And when US had their crisis in 2008, they thought that since they have a successful launch of QE by the Japanese, they should do the same as well. So they did it in 2008. We have QE 1, 2, and 3. And we saw how the gold has climbed. Then it comes stabilize with the quantitative tightening. Then there comes the COVID. And this time around, the Fed have robbed big time on the QE called the COVID QE program. And we saw that how gold have escalated. Now we have to see this relationship between QE and gold. So the next question I got to ask myself is this. In the next crisis, it will always come. Crisis is good. If you do not know how to manage it, it's bad. But we have to see beyond that. In every crisis, there's risk. Yes, we have to understand that. That's why we're here. But when there's risk, there's always opportunity. So I've got to ask myself this question in the next crisis to come. Will the central bank continue to rock QE? And my answer is likely a yes. Now, if this is true, then I think gold will have a chance to continue this upward trend. Now, let's take a look at the next slide. The T. Now, T is something new, tariffs. And tariffs started in a big way during President Trump's first term. And that was in the year 2018. Now, I could literally see that the first QE started in 8th of July and August 2018. Now, you could literally see that how gold has pivoted at this low on the announcement, and it started to move up, and from there it started to move up. That's for the gold market. Then when President Biden took over, basically everything remained the same, but he did something. In October 2022, the tariff was export control on advanced chip. And on the announcement, you could see that how gold has pivoted at the low, and it started to move up from here. Now, the next pivot on tariffs is when President Trump won the election between himself and Biden. That was made known in November last year. The moment we got the news, let's look at how gold has pivoted, because we know that he's going to come in again with Trump 2.0 tariffs. So, and that's what we are seeing here. Now, the next question is this. We are now here. We got to ask ourselves, if the tariffs is going to continue to happen, and if your answer is yes, now based on this case study, I would say that likely there's a chance that gold will continue to move up. Now let's study the last one, which is the D. It stands for debt. That if you look at this relationship, the debt over the last 50 years, yellow is the US debt, we could see that gold has been trading along the US debt. So again, we got to ask this question right now. Is the US debt at 36 trillion by right now? Is going to be continuous? And my answer is likely the US debt is going to continue to move up. So when this trail happened, the Q, T, and D, we've got to ask ourselves every quarter, every year, we've got to take accounts. Where's the Q, where's the T, and where's the D? Then we know that once we know where the main direction is going, in the turbulence, the daily turbulence, weekly turbulence, monthly turbulence that's always there, we will not be shaken. We will have a clear idea where the main trend is. Let's look at another significant point in history. So we discussed about March 2020. That was the QE, COVID QE. The next important year to take note is June 2022. What happened to June 2022? It was when inflation hit a high of 9%. This is exciting. Now, the next question is that earlier we discussed about what is the bond telling us when it starts to move down continuously. We discussed about trust issue. Now, it's also important to address that will this downward pressure in the US bonds continue? Now, these 2 dates to me is set the foundation of this understanding. Let's discuss about what happened in this 2 very important milestone for the bonds market and the global market, which is the year 2000, March 2020, and also June 2022. Now, I want to see that for the last 30 to 40 years, this is a US bonds. It has tread this very nice uptrend line, almost like a straight line ruler. If you look at the historic, from this low, it met at the lowest point. This guy met at the lowest point here. This was a false break, lowest point, lowest point, lowest point. There were many lowest points here. Now, so we saw that March 2020, that was when the COVID QE being rolled out. It was the peak at the point in time. Then when I was observing very closely about this uptrend line, I hope that it will not be broken. So in June 2022, that was inflation hit a high of 9%, but unfortunately what I saw is that it broke down this very major uptrend line, this major support, without hesitation and with great transaction volume. That's frightened me. Then I know that this trend may not hold. That was a time in June 2022, I have kind of have an affirmation from the market that the bonds is going to continue its downward pressure, technically and fundamentally, as we could see. And today we could see that the bonds are trending on this channel very nicely, and that was the Liberation Day tariffs announcement on 2nd of April. Now, why this 2 days is very important, let's study about during the year of COVID. Now we could see that the first QE that was being announced, that was the year 2008. It was 1.3 trillion US dollars. Now we have to understand that there's a good debt and a bad debt. So back in those years, they continue to print money and buy their bonds. Those are good debts. As they borrow and expand to expand their economy, those are good debts. But when it comes to a point of, if you continue to do that, the debt will not be sustainable. I wouldn't use the word bad debt, you haven't reached that point yet, but I would say that at this point, the debt is unsustainable. That became a danger. Now, but what happened to March 2020, it was, now look at this amount compared to this, from 1.3 US dollars trillion to 4.8 trillion US dollars. And I can say that the investors do not like it because they know that debt is good, but you have too much debt that it doesn't equate, there's no equilibrium to your output of production. That's bad, that's unhealthy. So investors do not like that. That's where you can see that from March 2020, the bonds have peaked. Now let's study about the inflation. And this was the CPI. That we could see that over the last 50 years, the CPI. Let's look at the trend right now. The inflation has been on downward slope for the last 40 years. But what happened to June 2022 was for the first time in history that the inflation have broke this downtrend line without hesitation. And that, to me, is a danger. When this happened, technically, I would say that could it be the first wave, second wave, and we're heading for the third wave. And looking at the fundamental development, the macro development, it seems like there is likelihood the third wave may come. That even for Walmart last week, he said, or they say that he warned Americans that they are going to pay a higher price because of the Donald Trump trade war, despite the a successful negotiation between the US and China. So we know that inflation is real. And I do suspect that the third wave is still in the making. We cannot rule out the possibility. So you have to look at these 2 days have shaped the market main direction in all fronts, whether it's bonds, the US stocks, the commodities, even to the stock market. And I totally agree with Park Edwin that when there's risk, we could see that there's fund flow into Asia. I'm so happy that for Indonesia that I could see that the rupiah has strengthened 3% when the Moody announced the downgrade of US bonds. Of course, I'm not happy with that, but in a way, I'm happy for Indonesia that the currency has strengthened 3% just by that announcement. Now, let's unpack everything. Where's the opportunity? Now, let me just break it down. And now, I try not to sound that in fact, I'm not a doom and gloom individual. I'm very positive all the time. Okay? But, we know that the debt, it became unsustainable. It's not bad at this point in time, it's just unsustainable. So these 2 days is important, March 2020 and June 2022, and we may be at a tipping point right now. Now, 10 years ago, of course, we heard about, many people share that the bonds may collapse, the US market may collapse. We heard that 10 years ago. I think we also heard that 20 years ago. And the first time I heard that the US is the greatest debtor in the world, that was when I became a teenager, when I was 13 years old, exactly 40 years back. It's from my Indonesian classmate back home in Singapore. And 13 years old as a teenager, he said that US is the greatest debtor of the world. But nothing happened because they were engaging in good debts, using debt to expand the economy. But come to a point that will be a tipping point. Of course, the million-dollar question is, when is it? Could it be this year? Could it be next year? Now, I can use these 2 important dates to kind of figure out March 2020 and June 2022. Now, let's continue to explore on what's happening. Now, to me, to understand about debt is a very simple mathematical calculation. When debt rises, without an equilibrium to your output in production, it also means that the currency will be weakened in terms of US dollars. Now, when your currency weakens, US dollars, it brings currency dilution. When currency dilution, it also means that inflation may accelerate. So it's simple math. Too much debt, your currency be weakened. And with currency weakness, inflation will come, and that's why all of the world we're experiencing inflation. Not just in Indonesia, back home in Singapore, in Malaysia, we're experiencing inflation. Because those who's responsible for printing money, they have export their inflation to all over the world. Inflation can be exported. Yes, inflation can be exported. Now, let's look at a currency that is very strong. So we've got to ask ourselves, is US dollars weak at all? US dollars is not weak, but to me, US dollars is very weak. So if I got to compare to a developed nation in US, I have to compare apple to apple. Let me just compare US dollars with Swiss. Swiss total debt, accumulated debt, last year was 360 billion US dollars, less than that. But US accumulated debt is 36 trillion US dollars, still on a climb. But of course, we can't just compare the amount, but we have to compare their debt to GDP ratio. But you know the answer. But let's look at the dollar Swiss to equate out, is the US dollar is really that weak to a strong economy? We could see that over the last 50 years, the US dollars compared to Swiss have depreciated by 5 times. 5 times means 500%. Can you see that, the weakness in US dollars? And last year, in April 2024, I was with CFA Society at a Japanese restaurant. So we share about the direction of gold in relationship to US dollars. That we believe that the dollar index will continue to move down. If dollar index continue to move down, US dollars continue to move down, it also means that the gold will move up. So we study into the relationship that gold is a currency. When US dollars down, gold will move up. That was in April 2024, exactly about 1 year ago. Now, April 2024, dollar index was at 105. So I'm expecting that the dollar index to continue to come down. If that happened, then gold, just about more than 1 year ago, gold was at 2003. When US dollars come down, it means that gold will have a good chance to continue to move up. And that was what we have discussed. So where is gold today and where is US dollars today? Now, I want to zero in on this figure, dollar index 105 and gold at 2003. So we could see that today, the dollar index from 105 has moved down to about 99, and gold from 2003, it went up to 3,500 US dollars. So last year we studied the inverse relationship between the dollar and the gold. As long as US dollars move down, we could see that gold move up in every cycle. And we saw an interesting phenomenon here between the US dollars and gold. When US dollar moved down 66%, gold moved up multiple folds, 600%. When US dollar moved up 46%, gold came down equilibrium. It means that based on this case study, when US dollars is down, the gold move up multiple times. This is based on study. Yeah. So I have to decode as gold in a very unstable world like this today, it became a currency against the US dollars. Now, I'm going to break this down with this very simple title, with that I will end. That what began well as a good debt, it grew risky. But in every risky situation, we understand that, to me, there's always opportunity. I want you to look beyond what we have read and what we've experienced. That I think is part of Asia or ASEAN, we are kind of experiencing it at the very beginning. I would say that I'm excited. There are many good days and years ahead to come. We just have to focus on the right assets. Let me just move on. How can we hedge? Now, we talk about debt and QE, where I believe that as long as debt and QE, remember the Q, T, and D, continue to be in place, the goal should continue to be on an upward trajectory. So, of course, you can consider to buy gold, or if you want to trade gold, usually when I have the main direction in place, I will also want to trade gold as well. So then I'll get myself engaged in the CME gold product, the regular gold, or the mini gold, or recently they have launched a 1 ounce gold for retailer. Now, so as we move on, I also observe with increase of debt and QE, the currency, when I say currency depreciation, I'm referring to the US dollars, that I could see that beginning of this year, that the yen has moved up with a bullish engulfing body. Okay? You can hedge this uncertainty using the yen futures. That I could see that beginning of this year, there is this bullish engulfing body in the pound futures or pound dollar. That I could see that beginning of this year, very strongly, just between January to April, the euro has been moving up. And I saw that the Aussie dollar formed a hammer just about 2 months back. It means that it suggests that the market will continue to move up. When Aussie dollar move up, you also refer to the US dollars is coming off. And I also saw that the Swiss continue to move up just beginning of this year to now, and so is the Canadian dollars. And for the dollar offshore yuan, where CME also carry that product in futures, that I could see that it is having an inverted hammer. For this pair, is that when it starts to move down, it means that the dollar is down, the offshore Chinese yuan is moving up. That we could see that with debt, increase in QE, and tariffs still ongoing, the US dollars, it seems to me that starting this year is starting to take shape. That is my focus. On currency that oppose the US dollars, I will be looking very tightly, could it be a buy on dip opportunity? Once it starts to trend, I may want to hold on a little bit more. Now let's look at the next inflation numbers. The first time I came to CFA Society, it was September 2023. That was 1.5 years ago. Exactly here, I presented this chart. And I put a pause here because that was where we were, where gold is still below 2,000 US dollars. But then we discussed that there's a potential that gold will continue to move up. And I make this statement where I hold very, very true even today, that I say that as long as gold maintain a high point, the rest of the commodities will, according to their timing and their underlying reason, may move up. So gold is the leader of commodities. As long as it stay on a firm note, the rest of them, I will find opportunity to get into it when the reason is right. But what we could see here was, I freeze the timeline here. So crude oil, park, you're right, it's not moving much, but the rest, soybean is higher, copper is much higher, cattle is much higher, hog is higher, corn is a bit more stable, coffee also went up a lot since September 2023. Yeah. Let's look at the yield. With that, there'll be a currency depreciation of US dollars. Commodities will start to move up. Then the yield will also start to move up. And what we're seeing here is a 40 to 50 years yield. 2 years, 5 years, 10 years, 30 years. Across the board, earlier we still remember we studied about the CPI numbers. It has broke above the 40 years downtrend line. How about the interest rate, the yield, across the 2, 5, 10, and 30 years? It has formed a very nice downtrend connecting all the dots throughout 2, 5, 10, 30 years. But in June 2022, it has convincingly broke above this downtrend. So my question to myself is that could this be a first wave, second wave in the making, and third wave to come? I think there's a possibility. So how you can hedge using the rising interest rate is CME have launched this futures about 2.5, 3 years back. They have the 2, 5, 10, and 30 years yield futures. Now, next one, I think bond is going to be depressed. So earlier we discussed about the peak in March 2020. Then it broke this downtrend line, and now it's continuing to move on this channel. But let me just encourage you with this skill set here. Did I manage to pick the top in March 2020? Can I share with you this skill set? It can be done. Let me show you how to do it. I start making this plan in 2016. Okay? But a lot of opportunities, sometimes you just have to wait and sit on it. There's always a delay. Now, let me just share with you how I figure out possibly that bond may have peaked in 2020. Now, this was a case study that I shared in 2022. Now, way back in 2016, now this is a yearly chart. I want to pay close attention on this yearly chart. That you could see that in history, for the bonds, it has never formed this inverted hammer, but it did in 2016. So technically, I'm seeing something. Now, so earlier I explained that 10 years ago I heard about those gloom and doom preacher. 20 years we heard about that, but I don't quite believe because the bond is still moving up. The interest rate is still low. So that's the basis. As long as bond is moving up, interest rate still low, I believe that the US stock market is still continue to be vibrant. But the clue that I have in 2016 was it formed an inverted hammer that I've never seen before in the history of the bonds. So I draw a straight line, I just mark it there. Now, in 2020, when COVID happened, it formed another not too classic inverted hammer, but this is a main resistance. I would view this as a false break. Now, where the real deal come to me that I have an understanding that bond may have peaked, it was in 2021, where I could see that there's an increase in selling volume. Not until June 2022, so I keep on repeating this date because I think it's in part of your muscle memory now. It's only in June 2022 it broke below the subtrend line. So that was the beginning of my campaign. That I continue to buy gold, I continue to watch out for commodities market may move up, and I believe that the bonds is going to continue to come down. So I hope that this is good sharing. Everything takes time. Yeah, so all these are technical studies, but you can see that how I gel it with macro analysis. It got to make sense. When two come together, it's perfect. Macro development plus technical analysis, this is where I build the confidence. Now, so this is volatile market, volatility in the stock market where we discussed about debt, currency, inflation, or commodities, rising yield, bond depreciation. Now, when all this happened, that was a case study I did during the first week of this year. Now, when I look at the monthly chart of December 2024, this was the first time I saw an inverted hammer on this parallel channel that I've drawn. Now, how did I draw this parallel channel is powerful. It's helpful to me when I analyze my macro development. That I drawn this significant bottom, you could see that how well it connect. That with this trend line, I find a significant historical peak in the past. When I project upwards, it was here. That was July last year, and that's December 2024, and I saw inverted hammer. So at the point in time, I kind of knew that technically that US market may have reached its top. And up to today, that top have not been broken. So my statement back then in beginning of 2025, it was US stock market is going to be volatile because of all this reason. Now let's look at what happened to the US market. We saw that US market went all the way down because of the Liberation Day, but you also pulled back up. But as long as the Q, T, and D is still there, my reading for the US stock market is this year, it will continue to be very volatile. That's my analysis at the start of this year. So definitely you can deploy the CME indices futures to trade or to hedge, especially for the fund managers down here today. Now let me just share with you one thing here is that on fundamental, something have changed. Now we could see that Ronald Reagan started this rule-based global order. He coined this idea. Now, in the 1981 to 1989, that Ronald Reagan promoted global capitalization. So it helps you look at how the market have performed. But it's not only until 1995, WTO taken place, motored by him. Yeah, so he's the man behind this WTO. Yeah, one of the key personnel. But it was on Liberation Day, it changes everything. That we have to understand because of the global order, it brought the US market into its bull run for the last 40 years. But this global order have changed. The whole global order have shifted. So the question is always, is 2025, could it be a tipping point for the US market? And I seriously have to entertain this proposition. It could be 2025, could be 2026 next year. But I think the time is near as we examine all these elements that we have discussed. So we heard that 10 years ago. But I want to see beyond that. It's not the risk I'm referring to. It is the opportunity that I'm referring to. Okay, so I showed you earlier throughout all these sequence, what are the products that's available that CME have carried. I think it helps me along. And let me just share with you this. Could you see that there's two inverted hammer? This is a quarterly chart. The last quarter in 2024 and the first quarter of 2025. And for the first time in history for NASDAQ, or what product is this? Dow Jones. For the first time in history, I saw two inverted hammer on quarterly chart. That also represents, could it be a double top? So we address about the fundamental shift on macro development, but technically, it is also showing me something. And you have not repositioned your strategy, I think, is the beginning of greatness to come. We got to restructure how we manage our position from the past, because I think the opportunity is now. And yesterday, Ramat picked me from the airport, so we have a very good exchange in a car. You know, I told him that my wife are very angry with me because when I start investing in gold in 2016, of course now 2016 the gold was about 1,004, 1,006. Of course now the gold is 3,005. And I used my personal fund to invest, and I did not do it for my wife. So my wife very angry with me. So I just told him a story that my wife insists that I should invest and trade using her money. So she also have some stash personal fund. I told her this. I say now to buy, invest in gold is a bit dangerous. It may take a breather. Okay. So now the thing about trading and investment is this. I bought gold in 2016. It may seem very glamorous today, but you know, sometimes it's very painful. From 2016 to 2020, gold has not moved anywhere. So then my wife, we have a very healthy, we mock at each other. She liked property, but I like gold. But I bought gold in 2016, nothing happened. So she wanted me to buy property. I said, no, I just want gold. So, but now as time passed, there's always delay. We saw how gold has multiplied. So I can tell you that when gold starts to move up, I have two portfolios. One for long-term investment, one for short-term trading into volatility. So since 2020, I hold the gold, that's long-term hold. But 2020, when fundamental shift, when gold started to move up, I started to increase my stake in the short-term trading portfolio. How do I do that? So when you have a general trend that the gold is heading up, my strategy is to buy on dip. So you could consider the CME futures, micro gold, or the 1 ounce gold. So I was going to give you my take about gold moving forward. And I told her that I will not invest in gold for you for long term, but I don't mind to trade, because when I trade, it means that if gold starts to take a breather, I suspect gold may take a breather to about 3,000 or even 2008, then I can get out very fast. But I say that I don't mind to have two portfolios for you in the silver. One for long-term hold in the silver, the other one short-term trading. I'm going to create two portfolios for her. That's what I'm going to do for her, because silver, I think the base is still very low. You'll be safer to invest and be quite nice to trade, because that is about $1.50 or $2 range every week. So I'm just going to do this range. Of course, today I didn't showcase the silver product is available in CME as well. So when I designed this topic I spoke about risk, but I want to see beyond the risk. To me, every time there's risk, there is opportunity. I hope you are seeing this. So at the end of it, of course, CME sponsored me to be here. When I look at their website, I was so pleasantly pleased that their team is also where risk meets opportunity. I hope that I can someday meet the team who is behind this, the think tank behind CME. And every time when I design a topic for them, I just felt that we're so in sync with each other. So these are the products that's available. You can scan the QR code and you can hedge in agricultural, energy, equities, and there's Forex, where I discuss about it. Interest rate matters, and there's all these micro futures that is available. Okay, last of all, I cannot leave without sharing on my direction about gold. I still like gold. Now, still, Earlier, do you still remember that I shared about Dow Jones on these parallel lines? On the, I think, quarterly chart on Dow Jones, right? You saw that. But now gold have the same behavior. Now, if I'm going to do all this significant bottom, I connect them together, and I parallel it to, in the 80s, the high inflation, and I project it upwards using the same parallel line, I saw this gold meeting the resistance at 3,005, technically. It makes sense. And to me, 3,005 is a very psychological level. Why? Because in 1971, no, I would say this, before World War II to 1971, gold was at 35 US dollars for that many decades. Until Nixon shock, it sends the gold to depart this marriage between gold and the US dollars. So now, from 35 US dollars to 3,005, to me, a psychological level. Why? Because gold have increased by 100 times over the years. It's just psychological. Okay? So now, with this tariff pause, I think the market are pretty happy, especially the investor who invest in America. But the pause is just a pause. It's not a reverse. Okay? Tariff can no longer reverse. It's like a switch. Once you switch on, even you switch back, it's no longer the same. The war has already been declared on the tariff war. It's no longer the same. Now, but the pause is going to bring some positive note to the US stock market, which is dead. But I think the pause is going to bring the gold to move down slightly. So what I'm seeing here is that gold may take a breather to about 3,000 to 2008. I cannot be sure on where it is, but this is what I'm seeing here. 3,005 is a psychological, but in terms of the development fundamentally, we could see that the tariff is on the negotiation ground. So the gold may be taking a breather. But as long as the QT and D still exists, I think gold someday will start to move up. So my plan is that now I want to trade the gold. As the gold continue to come down, for the gold futures, I will consider to sell into strength for the gold. While my long-term portfolio, I'll continue to hold my gold assets. Now, come to a time, if we break this parallel line that I've drawn, it may form something like this. Let me just revert back to the monthly chart, and this is what I'm seeing here. It'll be something like this year here, I can't remember which year, maybe 2022 or 23, where if I use the same uptrend channel, place it on the significant top, you could see it kind of take a breather around here. Very brief breather, that's what I saw. And then before I start to break above, sit on top of it, and I believe that gold may range around here before I start to move up here. I think it kind of sums up with the QTD matrix, why I feel that the gold is continuing to move up in the long term. That's why I have two portfolios, one for long-term hold assets, and the other portfolio is to trade, to build up my reserve. So with that, before I end with my presentation, these are the gold available contracts that's available in CME with COMEX gold, micro gold, and 1 ounce gold. So they are margin, but each of them carry the full contract of 300,000 if you buy or sell short gold at 3,000 US dollars. So the micro gold and the 1 ounce gold. So we can get connected through my LinkedIn. My LinkedIn is my name. My surname is Wong. My name is Con Hao, K-O-N-H-W. Would love to connect with you. And the rest are my other information on my YouTube channel, where partially CME also sponsor me to create an insight of the market every week. And that's the my personal email address, conhao@wikipedia.com.
Thank you, Mr. Con Hao. It is very interesting to learn that inflation actually can be exported, yeah, right,
Yeah.
Pak? We will have a panel discussion. I would like to invite Ray Laksana, CFA, CEO of DBS Vickers Securitas, Tommy Zhu from Agrodana Futures. We hope this discussion will provide valuable perspective and practical strategies for navigating the challenge and capturing the potential of Indonesian market. This panel will be moderated by Ms. Julia Simatupang, Country Manager and Chief Representative of ACCA Indonesia. Ms. Julia Simatupang is the Country Manager and Chief Representative for Indonesia at the Association of Chartered Certified Accountants, ACCA. She has been instrumental in driving the growth of the organization since December 2022, and she is developing impactful partnership and relationship with national bodies, regulators, university, and employer partners to further ACCA's strategic and growth ambition in Indonesia. Prior to joining ACCA, Julia was with the education industry for over 2 years, specializing in education advisory, consultancy, and sales. Her previous role includes stint with SP Jain School of Global. Please welcome Ms. Julia. The session is yours.
Ladies and gentlemen, welcome back. I hope you have refreshing intermissions. We now move into one of the most anticipated segment of today's conference, our panel discussions on Indonesia market perspective for the second half of 2025. Again, my name is Julia. I'm honored to moderate this session. And today, we bring together distinguished experts across market. They will share their insights across fixed income, equities, and commodities, and all through the lens of intermarket analysis. Without further ado, please join me in welcoming the first panelist. He has more than 90 years of experience in banking, corporate finance, and capital market in Indonesia and Singapore. He joined the DBS Vickers Securitas Indonesia as Business Director in 2021. He sits also in Indonesian Central Custody Committee. Ladies and gentlemen, let's give a grand welcome to Bapak Ray Laksana, CEO of DBS Vickers Securitas Indonesia. Pak Ray will provide an equity market perspective for our second half of 2025. The second panelist is a director of PT Agrodana Futures and holds the prestigious CFA, CFP, and also Certified Wealth Manager. He has experience in financial industry for almost 30 years with specialty in stock market, derivative market. He also actively contributes his expertise by giving lecture in prominent university in Indonesia and writing articles also for magazine. He has been appointed as board of jury for Property and Bank Awards and Indonesia Capital Market Student Study for more than 10 years. Pak Tommy will discuss commodities prospect in the remaining of this year, especially with gold, who's been in the spotlight up until recently, particularly among retail investors. So thank you so much, Pak Ray and Pak Tommy. I think let's just begin with a broad questions. Yeah, the broad question that we have is: what are the key macroeconomic signals you're watching as we enter the second half of 2025, and how are they shaping your outlook? All right, so this is the first question to all speakers. How's your specific instrument react with recent uncertainties, like tariffs that put us into geo-economic fragmentation and our local domestic market? I think we now move to from the equity market, Pak Ray. What are your views on remaining Q3 and Q4 of 2025? How is the flow and what sectors in the Indonesian equity market are showing resilience or vulnerability as we move into Q3?
Thank you, Bu Julia. In general, in the earlier session, I think we mentioned a lot about the impact of Trump, and that's also still true for the Indonesian equity. So if we talk about the impact to Indonesian equity, I think first of all we also need to see what is the impact of Trump tariff policy to the overall Indonesia macroeconomic outlook, right? So it was mentioned that the DXY is weakened as investors sort of like they lose confidence in the US dollar, and China renminbi, we think it will continue to weaken as part of the China strategy to maintain their exports to the rest of the world. Now, with that in the picture, we also see that rupiah still to be continued under pressure, despite the weakening of the dollar index. That's affected basically, which I will maybe discuss later on the Indonesia, our insight or domestic condition itself. Now, if we look, this is again, this is not investment advice. This is DBS view, right, on the macroeconomic and later on some of the Indonesian equity outlook. We forecast Indonesia GDP this year. If you look at the table at the top, is a 5.1% GDP growth for this year, with a 2.2% inflation, and the fiscal balance is minus. Yeah, fiscal deficit 2.5%. Now, if we look at the tariff that U.S. has mentioned to Indonesia, reciprocal rates of 32%, and we know that Indonesia export exposure to US is about 10% of our total export. Based on our economists, it translates into 50 to 60 basis point impact to our GDP. So if we are estimating 5.1 as our original case, the impact will become 4.5% to our GDP growth. Right. Well, if you look at the table at the bottom, 0.6%, relatively, I think, compared to some other country, which has larger exposure to the export to the US, I think we are relatively in the middle range. Right. Now, if we look at the overall JCI, our equity index, in the past, we see that foreign flow has been one of the key driver in terms of the JCI index performance. We see during the COVID where the foreign start to inflow to Indonesia, and then it also drive the domestic market to also follow on, and that drive the recovery of our index. During the geopolitical tension, commodity was one of actually the counter-cyclical during that time, and we benefit from actually the heightened or increase in the commodity prices during that period. So what do we see now in 2025, right? We see now, in the past, the domestic story of the strong consumption in the domestic market, as well as the commodity story, has been one of the supporting point to our index performance. Now this year we see that has faced some challenges. I think if we see starting from this year, there's a lot of news and also data that seems to show that there's some weakening in the consumer buying power in Indonesia. And the first quarter GDP was also about 4.8% below the typical 5% rate. So that story has started to sort of being challenged. And the second is a commodity boom. The recent commodity prices is slightly weakened, and therefore it also has not provided sort of some cushion for the JCI performance earlier this year. So what this translate, we think that 2025, second half 2025 will be more volatile compared to the previous years. Having said that, I think we will see some of some catalysts that may help the JCI performance going forward. Right. Number one is in terms of valuation, JCI right now is about 1.5 to 2 times below the normal standard deviation. And as well as in terms of the dividend yield, is one of the highest at the moment, right? So we think that will attract investors to come in, and later on will basically help the index to recover. And in fact, we have seen quite a strong recovery since April until now. Yeah, and also we see government programs are still ongoing, and we hope that to be realized. For example, the trade negotiation with the US, and other projects, including the Makan siang bergizi, MBG, we know there's challenges in terms of the implementation, but if it can be executed well, it will be good for the overall Indonesia economy as well as developing the human capital in the medium to long term. Yeah. Now, if we look at the chart on the JCI, the left-hand side, this is as of about mid-April. Our PE band is at -2 standard deviation, right? And in terms of the dividend yield, during that period also, JCI offers one of the highest dividend yield, at least in the past 10 to 15 years, right? And if we look at the right-hand side of the chart, we are comparing the earnings yield, that's earnings divided by the price of the equity, and we compare it to the 10 years bonds yield. Typically, actually the Indonesian 10-year bonds yield is above the earnings yield of the equity. But as of April, it's the vice versa, the other way around. So earnings or equity yield is higher than the bonds yield. So again, with these points, we think that it's quite attractive to enter into Indonesian equity market, given the valuation that is very attractive. Yeah. And for our view for the JCI this year, we think JCI may reach 7,350 based on 5% earnings growth, as well as 12 times forward PE ratio. Yeah, that is about 1 to 1.5 standard deviation below the JCI 5-year average PE multiple. Some sectors that we think quite interesting for the second half is that, for example, like the banks, because we think banks' valuation is attractive. The tariff impact may have been priced in, right? And so far we see that the credit growth and the credit quality is still acceptable. Number 2 is the consumer staples. The investment thesis here on the consumer staples is that we think the commodity prices, like the soft commodity and energy prices, will continue to be soft. So that means 2 things. One, the consumer has more disposable income; they can spend more. And second, the input prices for the manufacturers will also be lower, and therefore they may experience a margin extension. And the third will be the telco sector. This is 2 reasons. One is on the consolidation of the players, right? When there are 3 large players, remaining, typically those players will have a higher bargaining power. And second, also in terms of valuation, it's quite attractive if you can, depending on the share price, but it hits, some of the stock in the TMT sector actually provided about 7% dividend yield. Yeah. Sectors where we may be cautious for the second half is on the energy and the commodity. We think that with the potentially soft growth globally, then commodity prices will also remain soft for the second half. And also, our view is that given that the US may, due to a Trump policy, if the tariff is implemented, US may experience a higher inflation. And to counter that, we think that the US government may try to contain the energy prices, and therefore we think the oil and gas prices may continue or stay on the soft side for the second half of this year. Yeah.
Thank you, Padre, for your second half forecast. I think with Trump's toning down on tariff and pandemic valuation of GCI in no pandemic setting whatsoever should lure investors into bargain hunting the GCI. Okay, so now let's move to commodities and US stock index. Pak Tommy, how these instruments can be a good hedging strategy with volatility in the market? What should investors be watching most closely? You may share your view, Pak Tommy.
Thank you, Bu Julia. Excuse me for please allow me to stand up. So I think it's become easier for me to explain. Okay, so since our topic today is about second half, so it's also important for us to review what happened since the beginning of the year. So actually, if we look at the big events in 2025, we know that, and I believe Edwin, Mr. Wong also explained that since Trump's election as president, and he took office in January, then everything getting more and more chaotic. Yeah, and we see the peak was the Liberation Day. During the Liberation Day on the 2nd of April, the stock market collapsed. And what happened after that? During the 1 week after the Liberation Day, a lot of countries tried to negotiate, and finally, Trump mentioned, okay, we put on hold the Liberation Day tariff. Every country got the 10% except China. And what happened to China? China from 34% become 145%. So everything is become more chaotic. And we saw only by May, they have a truce. China and US make a truce, and everything now, until today, we are in the feel-good moment. So this is a big event that we review in January until today. So what happened? From the Liberation Day, S&P tank, Dow Jones tank, NASDAQ tank, even WTI is the West Texas Intermediate, that means the crude oil for the US production, also dropped because everybody become pessimistic about the productivity of this world. The economic will shrink, and so on and so on. Stock market drop, crude oil drop, and gold shoot up. It's like on the rocket going to the moon. This is what happened. And when you saw Mr. Wong's presentation, gold went up from 3,100 to 3,500. But because of the Liberation Day, the drawdown, that means the highest point, the latest high, to the lowest point, everything become bear market. We saw the news, S&P enters bear market, NASDAQ enters bear market, right? And total drop is more than 20%. But after the US and China truce, suddenly the headline twist. From the bear market, now we are entering bull market. Very interesting. Just in 1 month, April bear, May bull. So this is what happened to our global market. Yeah. While the gold, after 3,500, during the China and US make a truce, gold dropped. Mr. Wong mentioned as take a breather. The gold dropped to, right now is 3,200s. Yeah, so this is what happened for the last few months. And that means the volatility has increased. I never saw April bear market, May suddenly bull market. Normally bear market will last for a few months, or bull market will last for a few months, or maybe years before it turns. But now in 1 month, it happened. And also for the gold market, if you look at the gold price movement, average daily price movement since January 2024 until March 2025, the average is 1.35%. So one day, the high and low is only 1.35% of the price. But after the Liberation Day, now the average daily volatility double, 2.7%. So volatility has definitely increased, Bu Julia, because of all these things that happen. And so what can we expect for the second half, especially gold and US stocks? So let's discuss. Maybe this headline is not really in the news, yeah? But if you pay attention, especially for the US banks, starting July, they can count gold as 100% of the value. Why? Because gold now is a tier 1 asset according to the Basel III. So gold is now high quality liquid asset. Before July, it is only 50%. So I believe this will give incentive for banks in the US to have gold. Why? Because normally they only have the choice of US treasuries. But if you also pay attention to the presentation just now, the US treasury may go down. It could be in the downward pressure. So maybe the banks will try to think, okay, if I don't hold the US treasury, what products can I have? And now gold is considered 100% value. So this could be an incentive for the US banks. What else? This is very interesting, yeah? We know US is the country who has the most gold reserve. US holds 8,000 tons of gold. And then the second biggest, like Germany, and then France, Italy, and so on, including China, yeah? German, France, Italy, they hold 70% of the reserve in gold. Even Portugal is 84%, but Portugal is a small country, so the value is not significant. But if we look at Germany, France, and Italy, they hold more than 70% of their reserve in gold. While we look at the right side of the table, China, Japan, Singapore is only 5 to 6%. And if you look at the number of the total reserve they have, China is having trillions of dollars. And these trillions of dollars is only 6% in gold. If you pay attention, like Pak Edwin mentioned, BP Jam Sostek wants to increase the stocks allocation from 10% to 20% in, let's say, 3 years' time. But Pak Edwin mentioned we would like to have it maybe in 1 or 2 years' time. So can you imagine if China and Japan increase their gold allocation from currently 6.5%, 6.6%, let's say to 10%. That means 3.5% of the total reserve. These two countries itself, the total reserve is almost 5 trillion. 5 trillion times 3%, then it's already hundreds of billions. So it could be a good demand for gold in the future. Yeah, Singapore 5%, India 13%. Just look at these 4 countries, we can imagine the demand for gold is very big. Okay? And if you look at the past performance, gold has performed steadily. For the past 20 years, the compounded annual growth rate, the CAGR, is around 9%. And it surely beats the inflation rate. US inflation rate, maybe average is around 2%. So with compounded annual growth rate of more than 9% for the past 20 years, it is a very good inflation hedge instrument. Okay? And what else can we expect? During the China and US made a truce, and then Scott Bessent, the US officer, mentioned, it is implausible that the reciprocal tariff on China go below 10%. But the 34% could be the ceiling. It is very interesting. We are in the feel-good moment. From 145%, now become 30%, everybody feels relief, right? And if we look at this statement, that means the tariff will be there. It won't go below 10%. Maybe it will not go above 34%. But can we imagine if, let's say, we are a producer and suddenly our products are being taxed 30% or maybe 20%, will we make the same expected profit as if no additional tariff? I believe this one will be hard. The profit is not shown yet, it's not reflected. The effect of tariff on the profitability is not shown yet on the company's performance. But I think this one will have effect because tariff is still there, right? And so what happens if the tariff will be really implemented, maybe 20% to China or whatever percentage on every country? Definitely it will affect the global trade. The global trade will be impacted negatively. And what happened? Currently, the S&P 500, the PE ratio is at the 96th percentile. That means only 4% of the time, the PE ratio is higher. If 4% of the time is higher, that means we are already at a very high level. When the PE ratio is high, it might implicate our pricing, our current price is already high. Or if we want the PE ratio to go down, we can expect if the profit of the companies can really go up. If the price of the company is stable, but the profitability go up, then the PE ratio can go down without the market being collapsed. But if we look at the tariff, can we expect the profitability to go up? I don't think so. So this is very important that we are now at the 96th percentile. That means we have to be very careful. Any bad news can make the market crash. Bad news about inflation, bad news about profitability, bad news about the trade deal, we don't know. But we have to be very careful at this juncture of time, yeah? Okay, so expect volatility to be there. When volatility is there, how can we overcome this volatility? First, always have the long-term view. Because if we are in the woods, we cannot see. We only see the trees. We have to view from the top, long-term view. When we have long-term view, we are not afraid when we are in the midst of the chaotic market. Yeah? And then use dollar cost averaging. Dollar cost averaging means you put every same amount of money at the interval. So you are not worried about whether this is the high or this is the low. You just keep on investing at the same amount of money at the regular interval. So this is one of the ways to overcome volatility. And the third one, diversify. Don't put all your eggs in one basket. Diversify. And the last one is hedge the downside risk. Hedge the downside risk using some derivative instrument. Yeah. So when we have volatility ahead, don't forget these 4 tips so that you can navigate the market clearly. And like the long-term view, why it is important? Some research by the UBS, for the past 10 years, if the Nasdaq drop, let's say, if you look at the 6th bar, so if the Nasdaq drop more than 25%, the next 1 year, it can perform more than 25%. If you look at the 3rd bar, if the Nasdaq drop 10 to 15%, then the next 1 year, it can go up more than 20%. And we know, because of the Liberation Day, everybody is saying bear market, that means the drop has been more than 20%. So if more than 20%, that means the 5th bar. So if the low is there, if the low is in, then we can expect the next 1 year, Nasdaq can go up by 25+%. So having long-term view is important, and the diversification, when we diversify, we try to have assets with low correlation. With low correlation, that means If this one go up, maybe the second asset is not going up that much, or maybe go down. That's diversification purpose, to spread the risk. So if we look at this table from Bloomberg, gold compared to US equity, the correlation is only 0.06. But if you see gold and international equity, the correlation is 0.72. That's why we always witness, last night the US stock market crashed. Then what happened to Indonesian stock market? Normally also minus, because the correlation is high. But with gold, US stock market crash, not necessarily the gold will crash, because the correlation is low. That's the point of diversification. Okay, that's all I have to share, Bu Julia.
Thank you so much, Pak Tommy, for an interesting view of gold and US stocks. I think, as the wise man says, Pak Tommy, every cloud has a silver lining, but bull will come after a bear in the US equity market. So I'm sure gold also provides a hedging opportunity with low correlation to other asset class. So very interesting sharing, Pak Tommy. So thank you all, gentlemen, for your outlook. It's very interesting with this dynamic that may build up trading opportunities in the market.
Okay, thank you, Bu Julia, Pak Ray, and Pak Tommy. My name is Budi from Sampurna University, Faculty of Business. So my question will be related to the education industry. So we have a lot of students that interested in the financial sector that maybe pursue careers in your company, such as Agrodana and DBS. So my question is that, what are the emerging trends or niche area within your respective company, or even the broader industry that offer the most significant growth opportunity for young talent? And if I may, my second question is that, with Indonesia focus on downstream processing and also ESG initiative, how do you foresee this trend will impact the career paths and job creation within the financial sector? Are there specific roles or expertise that will be high demand in the near futures? Thank you.
Thank you, Pak. You want to answer first?
Okay, thank you, Pak Budi.
Pak Budi,
Yeah. So we know that technology has helped a lot of traders. And even in my industry, like the derivative trading, technology also help traders to do the trade. So if students, especially the young ones, normally they are very aware of AI growth and then the automation. So I believe if they can master these tools, they can make their own trading system, they can offer these trading tools to other traders, and I think this one could be very beneficial for them. Like in my industry, the automated trading is like robotic. So everything is done the trading. You just put the algorithm so that they will execute your order exactly as when it happens. So I think this is important. And with AI, it is even more unimaginable, because AI, they can try to create their own system and they can also execute. So I think these two skills, I think, is very good for the students to master. Thank you.
Yeah. So for the second question, Pak Ray would like to answer?
Right. Yeah, I think on the ESG, I think it's becoming more and more important. For example, in our company, we have a special team, we call it the ESG desk, which, a lot of the proposals, right, including in the banking side, when we do the credit proposal, it has to go through the analysis by this ESG team. Basically, they will, check and, comment whether the company has followed the ESG requirement based on our internal standards. So I think it will remains to stay, and in fact it will grow importance going forward. So I think having a skill set in ESG definitely will help. Maybe in the future, there may not be a sort of like a ESG team per se specifically, but it's going to be embedded in the culture and in the day-to-day, of everyone practices. So again, I think that skill set will become very important in the future. Yeah.
Thank you so much, Farid.
What the impact of US and Saudi meeting in second half for the asset class, like equities and bonds?
Yeah, I think we don't know exactly what will be the impact to Asia at this moment, right? But I think I assume this is you're talking about the the agreement of the investment, right, from Saudi into US. I think potentially it will help to sort of boost the investment and the growth in the US. But how that will translate into Asia, it depends to actually many factors. For example, like will the tariff still continue for Asian countries, or will there be U.S. investment? Right? Now U.S. having more funds available through the investment. Will that U.S. make the investment into Asia? So I think it's too early to say at this moment, but I think overall should be positive in terms of like if we take into account the global growth. I think that potentially should be positive.
Right. You also agree with that, Pak
Yeah,
Tommy?
if I may add, yes, US and Saudi deal, yeah, it should help a lot of US, yeah, definitely, if really they deploy the money and then really invest in US. But as Pak Ray mentioned, it's too early to say because we don't know and we haven't seen the realization of this investment project. Even though we heard that like NVIDIA, Jensen Huang mentioned in the White House that they are going to invest hundreds of billions. So all these are celebratory statements that we have not seen the realization. So we need to see whether they really deploy the money to invest and open maybe projects so that more recruitment, hiring happen. We don't know. We should wait for further clue. Thank you.
All right. Thank you so much, gentlemen.
Thank you. My name is Anthony Tris. I'm from BDO Valuation and Financial Advisory. I would like to ask Pak Raya. You mentioned that we have to be cautious on commodities. I think in Indonesian market, commodities maybe consist of three biggest subsector. One is energy, second is palm oil, and then the other is metal, gold, something like that. But from previous presentation, it seems gold is leading every metal, right? And it's already high. Even it's volatile, it's high compared to previous years. So I would like to ask you to elaborate more on the subsector of commodity. My second question is, Pak Tommy said that gold has low correlation with other assets. Yeah. Suppose I invest in metal like Antam or whatever company is metal commodities. Is it good for diversification? Also considering your view on cautious for this kind of commodity equity. Okay, thank you.
I think to answer your questions on commodity, I think on the metals, I think gold is probably is slightly different from the other metals because gold has been used as a more on the safe haven, right? So in terms of in the time of volatility, people switch their investment into gold, and therefore we see that the gold prices has moved up, right? But the other metals are mostly used for industrial and manufacturer purposes. So at the times where volatility and there's a pressure towards growth, meaning the growth is expected to be softened, then the other metals will start to actually become softer as well. For example, like steel, nickel, right? And also we need to see the industry dynamic. For example, like nickel. Are we seeing potentially oversupply in the market? Actually, that's one of the concern right now. That's why the nickel price sort of a bit weak in the past 1 week or 1 year, because lots of these facility are expected to go live into the market, and would then, after all this goes live, will there create a oversupply, right? So again, that's on the metal side. On the CPO, it's also again driven by the overall global and also domestic growth, and also CPO itself may be impacted directly by the Trump's tariff. So that's something that we need to watch out for. Yeah, otherwise I think the CPO prices would continue to be stable. Oil and gas also affected by the global growth, and as well as which I shared previously, that potentially the Trump government may continue to pressure the energy prices to contain inflation in the country.
The question is considering the low correlation between gold and other assets. Can we say invest in Antam company producing gold with other asset, and it works in Indonesia or not? I'm not sure about that.
Yeah, okay, thank you for the question, Pak. So we know that a lot of people think, let's say, okay, we believe gold is on the upward trend. So we want to invest in gold producing stocks, let's say. But we have to be very careful about this judgment, because gold producing companies, not necessarily they can manage their cost efficiently. So if the gold price go up, but their cost structure is not efficient, it doesn't mean higher gold price is higher profit for the company. So if we look at the gold, it's better to invest in the gold itself instead of finding gold companies. That's my opinion. Second, when we are investing in the gold producer companies, normally it is considered part of the whole market. When the market tank, normally maybe 90% of all the stocks also go down. So let's say we believe Antam, let's say, when the gold price go up, Antam should make higher profit, so the price should go up. But if the total sentiment of the market is negative, it could be very hard for Antam itself to go up against the market. So that's the thing that we have to be cautious about. And a lot of people in Indonesia especially, because they only know how to invest in gold, is buying the gold bar. And if you look at the gold bar price, the difference between the buy and the sell, or we call it spread, is around 10%. That means if the gold price up by 10%, you are still break even. Right? So investing in gold, in the gold bar, bears the highest cost in my observation. So what can we do? Right now in Indonesia, they have digital gold, like what you may find in BSI, Pegadaian. They are offering digital gold. The spread is lower. It's around 3%. So definitely it is more efficient compared to investing in the gold bar. But if you want to find that the lowest spread is in derivative, so like what CME offers, like what Agrodana offers, the spread is very small. It is 0.0 something percent for the spread of the gold. So if we really want to have the intention of the investment is to have price appreciation, and we don't care about having the gold bar, touching the gold bar, then we don't need to invest in the gold bar itself. So first, answering back to your question, investing in gold or in the gold stock, gold producer companies, it's two different things. If you look at the gold price to go up, it's better to invest in the gold itself instead of the companies that produce gold. Second, when you look at the gold, so how you want to invest? There are three choices: investing in gold bar, but definitely the highest spread. Invest in the gold digital gold, or invest in the gold derivative. And what is interesting about derivative gold, the underlying asset is gold, and the gold should be the highest quality, 999 purity. And it is registered in the exchange, so guaranteed by the clearinghouse, so it's all safe. And then, when we do the trading in derivative, all is using leverage. All derivative use leverage. So what is the benefit of using leverage? Imagine if we want to buy 100 ounce of gold. If we buy 100 ounce of gold, let's say the price is 3,200. That means we have to pay $320,000 to have 100 ounce of gold. But if we are using leverage, we don't need to pay 320,000. We just pay the minimum amount. So how much? Let's assume 20%. So we just put up 64,000. Put 64,000, you buy 100 ounce of gold. And when the price go up, let's say to 3,500, that means your profit is 300 per ounce times 100. That means your profit is 30,000. When your initial capital is only 64,000. Because we are using leverage. But maybe you will ask, what happens if the price go down? If the price go down, then our deposit or the collateral, 64,000, will be deducted by the clearinghouse according to how much you lose. If let's say the price from 3,200 drop to 3,100, so we lose $100 per ounce, times 100, so we lose 10,000. So our money from 64,000 is now left by 54,000. So what happens if the price keep going down? If the price keep going down, then your money will also go down. From 64,000, now become 54, 44, 34. And this leverage will require us to top up additional fund. Maybe if you are having margin trading in the stock market, we call it margin call. Now, when we have a margin call, that means we need to top up our account immediately. Because if we don't top up, then the market keep going down, then the clearinghouse will liquidate your position, or maybe we call it for sell. Maybe in the stock market, for selling. So we will have automatic liquidation if our fund is not enough to maintain our position because of the price keep going down. But can we imagine how much low can the gold go down? Now it's 3,200. Can it go back to 1,000? If we don't think it can go back to 1,000, that means we will never pay 320,000 like what we pay in the physical market. So I hope this helps in making decision when we want to invest in gold. Thank you.
Excellent, Pak Tommy. So let's give a big applause to Pak Tommy and Pak Ray for their insight now. I think that's the end of our sessions for today. So thank you to our panelists for their insights and to our audience for the thoughtful questions. This session has certainly deepened our understanding on Indonesia market outlook for the rest of 2025. We'll now transition to our next speaker, Mr. Johannes Nugraha, who will explore the evolving landscape of climate finance in Indonesia. Please stay with us.
We have the pleasure of hearing from Mr. Johannes D. Nugraha, Chairman of ACCA Indonesia Member Panel, Group CFO at Gunung Sewu Group, who will share his insights on the critical topic, weathering the storm, building resilience against climate disruptions. In this session, we will explore how business and leaders can strengthen the resilience in the face of growing climate challenge. Before we begin, allow me to first share a brief profile of Mr. Johannes Nugraha. As a seasoned finance professional with over 20 years of experience, he has a proven track record in both global and multinational companies and local groups. Currently serving as a group CFO at Gunung Sewu Group since January 2024. Johannes leads the finance IT team across diverse sectors, including insurance, food, and property. Previously, he held key roles such as CFO at Kraft Heinz Indonesia, Papua New Guinea, Vice President at Finance at MAP Active Adi Perkasa, and various leadership positions at Unilever Indonesia and Mondelez Thailand, after 10 years at Kraft Foods Indonesia. Johannes is an ACCA member and holds a bachelor degree in accounting from the University of Surabaya. Without further ado, we invite Mr. Johannes to take the stage. Yeah.
First of all, it's really nice to be here, to be having the opportunity to share with all of you a little bit about kind of a different topic, probably less sexy than the hot topic of geopolitics and the tariffs, or how to invest in gold and all that stuff. Today, I'm going to talk about climate and its impact and how we can prepare for it. So I think when we talk about climate in the last decade, right? Just trying to recall our memories together. What was the last few events that we can recall recently? The one that I can recall very recently was the flood in Bekasi, right? We in our group we have also we have one property there, a mall, which fortunately was not impacted, but the immediate surrounding was impacted. It delayed the operations, of course, and etc. And what else? I think when we talk about climate, it's not just natural disasters per se, right? We talk also about flood, long drought, and then in my previous company as well, where I worked prior to joining this Gunung Sewu Group, I also worked for another food company, which is Kraft Heinz Global, which is in Indonesia. And there we have one line of product called the canned sardines, Sardine ABC, if you guys have ever consumed one. In fact, actually for this kind of business also impacted directly or indirectly. The supply of sardine, for example, used to be very abundant in Indonesia, but I don't know if you as consumers realize it or not. Actually, I would say more than 70% of the canned sardines that you eat are actually imported, right? They are imported. Considering that we are one of the largest archipelago nation or country in the world, we no longer have sardines to supply our own local demand. So today we're going to talk about climate and how we both as the business person, business owners, and also as investors, in a way, I would say, or simply as a member of society. What can we learn from the climate and the climate change and how we can prepare for it? So, bit of trivia, only 20% of businesses overall are prepared for climate-related disasters. And this is a survey done by ACCA, so don't hold it against me. I'm pretty sure it's pretty accurate because the sample also taken from various countries, not just Southeast Asia, but it's also globally represented. So even on a global scale, only 20% of the businesses that ACCA talked to or interviewed are prepared for climate-related disasters. So before we go into the content, let me share, the overall findings. Number one is basically the fact that accounting or accountancy and finance people or profession can drive the transformation toward climate resilient organization. In fact, I think that is one of the most influential catalyst for the transformation is in fact in finance. So we should be proud, but at the same time we should be anxious about whether we have done enough or what should we do more, right? Number two, organizations are not prepared for climate-related disasters. Most organizations would have some form of business continuity plan, right? In the case of earthquake, in the case of whatever. But mostly are outdated. They're not updated as frequently as the changes in the climate events itself. Because the climate events also is changing over time. Like how, let's say, the long drought, how frequently it's happening. El Nino is actually happening more frequently in the last decade compared to the previous decade. Right. So number three, resilience is not, unfortunately, not a priority yet on our members' agenda. 2/3 of the respondents in our survey not investing in climate adaptation. Number four, organizations need to consider impact of distributed workforce, societies, and the place they live, digital-first approach. Must consider also the effect of working from home and the overall employee well-being. And then the last point is that the government and businesses need to collaborate, and it is a crucial factor to balance the climate adaptation and decarbonization with clear policy, data access, etc. Right? We'll talk more about that soon. Okay, so the first one, the following few slides are more on survey results. So this is somehow for our knowledge and also see if it also resonates with your organization, either with the company that you work for or in the company where you invest in. Right, so which of the events can cause operational disruptions to your organization or clients? Which of the following have impacted you? So, in fact, the top four, I think the ones above 30% or 30% or above, mostly are with power outages, supply chain disruptions, which include also sourcing, the manufacturing, and probably also some distribution, right? Employee health and absenteeism, transportation disruption, right? So those are the top four, or probably one more, financial loss as a top five. I don't know how much this relates to you, but, and then the rest, of course, as you go down the list, there are different impacts that have occurred in the organization. So we look at specifically on Asia Pacific. So the thick blue line is Asia Pacific, and the rest of the lines are different parts of the region in the world. In fact, if you look at the general trend or shape of the curve, it's pretty much similar with the global trend itself, right? So the first four on power outages, supply chain disruption, employee health and absenteeism, transportation disruptions are four of the most common factors or variables that is being impacted by the climate change. Now we talk about how well prepared is organizations or clients in addressing and mitigating physical risks caused by climate change and their potential impact on operations. Only 9% is having comprehensive preparation, including the climate adaptation plan. 22% have business continuity in place, but not yet reflected or updated. 38% have some preparedness for business continuity in place, but not fully comprehensive. No plans in place and don't know, total of 31% for both. So I want you to probably also take a few seconds to reflect back on your own experience or on your own organization currently, right? So where you are today in your journey, do you have some sort of BCP in place? Does it cover also or include the climate change impact into your BCP or not? So 58% of the organization have business continuity plans to address sudden disruption of the organization. If you go down the funnel, 36% have the business resilience capabilities. Go down again the funnel, only 20% is horizon scanning, identifying potential climate-related risks. So basically it's considering, but not yet having a plan in place, nor having the capability in place. Only 17% is doing scenario testing, rehearsing responses to major disruptions. So I would say in my previous experience working for several companies, I would say in this case, Unilever probably is the one that is prepared the most in terms of scenario testing. When I was there, I was involved in some of the scenario testings that we have on the BCP, right? But that was more on the BCP, but not yet the comprehensive climate adaptation resilience, I would say. And 25% no mechanism. So what is the message here? I think this slide is pretty simple. So what do we need to do, or what do we need to invest in? How do we upskill our organization to prepare for this? Basically, the middle part on how to mitigate, how to adapt, and how to transform. These are the three main items or things that we as organization need to prepare, right? And the top icon, which talk about just transition, just transition is basically process of shifting to a low carbon and climate resilient economy. So it is a process still going, right? With decarbonization as one part of it. But not only that, the whole economy is shifting towards that. So the thing is that with just transition, we need to expect policy and regulation changes. We need to expect market changes, consumer preferences. Like myself, I now prefer driving electric vehicle rather than the traditional cars for the same reason. Social economic impact can be both positive and negative. One could be job losses in high emitting industries, right? So if you have a traditional industry with high emission, probably not right now, but in a few years from now, you might see job losses if the industry doesn't transform. But on the other side, there might be new jobs that can be created which relate to green-related jobs, right, on sustainability and etc. Moving on. So this wheel, I think most of the business continuity plan that we have in place relates to the bottom two, which is respond and recover, right? So basically, we prepare a scenario which particular risks that might happen and how to respond and then how to recover as quickly as possible to resume operations at at a level where we expect them to be. But we lack the top part, which is on the learn, predict, and adapt. Now, this is the part that we need to think in the overall scheme of things, not just about how to resume our operations, but also the long-term trend of the climate, the long-term trend of the change in the consumer preferences and behavior, etc., etc. So why do we need to invest in the resilience? So when we talk about resilience in climate adaptation or climate change, it's not just about the immediate, as I said, right? It's not just about the immediate, what if earthquake happens? What if flood happens? What do we do? But it's also looking at the longer term view of how our business and our business model will shift due to this climate change, right? So when we say that we are prepared for this, then you have the resilience. So, but why do we need to invest now? It's because we can minimize disruption cost. We can enhance customer confidence, for sure, right? I mean, if you're, let's say, if you're supplying agriculture product to your customers, and your customers, let's say you export to Japan, they have a very high standard, right? Or if you export to US, they also have very strict contract about how much you should supply, in what condition, etc., etc. But imagine if, you know, the way we are designing or the way our business is designed and put in place is like all eggs in one basket, one location, no diversification, no contingency. Then if something happens, then we would lose also confidence from our customers. Investing also help us improve risk management practices, ensuring regulatory compliance, for sure, fostering agility and adaptability, ensuring business continuity, and driving long-term sustainability. So another survey. So this is a survey about how perception on the planning for climate adaptation and efforts in to reduce the impacts of climate change, right? So 21% say that investing in these things are additional costs for our business. 29% say it's essential to avoid economic losses. 33% say it's an opportunity. And 17% says don't know or not applicable. I think here, at least, there's bright 1/3 of the pie that talks about an opportunity, right? So we should not only look at climate change as a risk, but it's also an opportunity, right? An organization, a market leader who is not well prepared for the climate change can be displaced by other competitors who are prepared for the climate change. So this is an opportunity, if you can look at it from that perspective. All right, so what do you think about spending to address and mitigate physical risk caused by climate change will look like? Mostly, I think about 37% says it will be increased, but the rest either stays the same or decreased, right? So this is not very encouraging yet. We need more, let's say, commitment on investing and addressing the climate change. So what are the drivers for resilience planning? Basically, what motivates the organization to invest or to plan for resilience? Mostly is business as usual during these disruptions, right? So to ensure that something happens, you can still operate as per business as usual. That's the largest motivator, I would say. And then long-term survival of the organization, etc., etc. Whatever your reasoning is or your motivation is, I think it's good to at least consider whether, you know, are you completely free from the impact of climate change or not, right? I think, in my opinion, very, very few business would have zero impact against climate change. Whether you're in agri-food industry or you're in, even one of our subsidiary in Gunung Sewu, we have actually a subsidiary in mining. Even mining is impacted by climate change. How so? Because when it rains hard, it's difficult to do the hauling, you know, the coal extraction. We have a coal mine in Sumatra. So even industries that doesn't seem to have any relations with climate actually is also impacted by climate. If you're operating in fashion industry, does climate impact your consumer preferences? Probably not directly, but I would say it does in certain ways or forms. If not, directly changing the consumer preferences, it might impact their income if they work in, in different industries that are impacted by climate change. So it's a complicated web of cause and effect. So the message here is really, don't take it lightly, I would say. And it's always better to be prepared. But of course, you don't have to invest everything at one go, and you can do your prioritization and all that. I think we have some toolkits that we can share with you at the end, which probably we'll not have time to talk about today. But anyway, I'm going to continue my presentation, and then we can talk about where to get these helpful toolkits. So what is the call for action for our organization? So one is the easiest one that costs no money, hopefully, is to understand and assess your business risks. Unfortunately, I can say with confidence that not all organizations have even this, right? The assessment of the business risk. What they have probably is a general assessment of the competition, but you don't have the overall assessment of the business risk from different angles. So if you don't have, this is a good place to start. Number two is embedding resilience in business strategy, meaning that, let's take, for example, the trend on decarbonization, for example, right? If you work in, even like in food industry, it is still relevant that you are, you can claim whatever zero carbon footprint or whatever it is, right? So it's not just to ensure that your business is running as usual, despite all the climate changes, but also to capture the future opportunity. So hence, in your business strategy, when to invest, where to invest, how to develop new product or services, and how to include or embed this climate change into your strategy is another good place to start. And I don't think it costs money as well. Scaling up investment in mitigation and adaptation. Now we're talking about some investment, right? So whatever it is, let's say diversifying your manufacturing operations, for example. Instead of one large mega factory, you might want to look at 2 or 3. I think the principle is the same, right? I mean, like the gold investment we heard earlier, and the stock market and the gold investment. You don't want, like you have 2 factories, but they're next to each other, for example, or the more disconnected it is in terms of the common variable, like whatever it is, it's better for you in terms of reduced risk. Communicating with stakeholders, I think this is also a very important factor. And then finally, advocating for climate resilience. Now, advocating for climate resilience is an interesting point, because I think to arrive at the ideal level where the economy or the just transition can happen like in the ideal state, definitely cannot happen just from the internal effort from our own organization, right? We will not have enough money or energy to tackle the climate risks by ourselves. It needs collaboration with the government, supported by incentives, regulations, policies, etc. And we need even our competitors to work together, actually, to prepare for a better climate resilient economy. So being an advocate in this matter is a win for all. Now, for the government, what do you think will happen to government policies designed to transition the country where you work into a greener economy? So the different colors of the bar represent different region. North America is red, Asia Pacific is the blue one, Western Europe and Africa is the green one, Western Europe, the yellow one, and Africa is the green one. So let's look at Asia Pacific. In this example, I think most, it's actually the highest out of the all region, that they basically, there will be more and more government policies that will come out. And again, the sooner we adapt to this, the better we have a position also to negotiate with the government in terms of more fairer, let's say, transition. Because sometimes government can be very abrupt in releasing a new policy, not considering the readiness and the time and the cost required to transition, right? So the sooner you get into it, the sooner you can collaborate with the government, then it will be better. So the call to action for the government itself is, again, collaboration between governments and businesses. Again, it's very important. It needs collaboration from both sides. Regulation for resilience, implementation of ISSB recommendations, private sector action on climate resilience, data to support business decision making. This means like the data collection and the data sharing as well from the government. How can it help the private sectors in making decisions? And then finally, capacity building for climate action. These are not easy, definitely. It's not a one-year journey. It's going to be a medium to long-term journey, but it's good to start now. Finance, as I said in the beginning, have massive opportunity in playing the role of transformation agent or agent of change in our respective organizations. However, to play that role, actually, there are skill gaps that I think we should all be aware of and realize. Hence, we need some upscaling, value in decisions, data to drive insights, new performance measure, one language, and leveraging our core skills. I think one good way to start promoting a little bit of ACCA sustainability diploma is probably one good place to start. At least designate 1 or 2 people from your organization to be certified. That it will give you sort of the overall knowledge on how to manage the climate and sustainability initiatives in your organization, right? But definitely finance plays a key role here. Okay, so finance leading the change in what sense? I think facilitation I mentioned earlier, data quality management, looking at the bullet points on the right. If you experienced, from building your career from the bottom, then you will know for sure how sometimes data quality is a big pain in our organization. I still have that issue every now and then. Reporting is another area where we can contribute. I think scenario modeling is probably the most value added in helping the top management making that decision. And then lastly is the financial planning and analysis, taking the scenario modeling, scenario planning into the financial impact at the end of the day. So where to start, right? Actually, ACCA has toolkits and videos that is free to access. It's available there. Actually, most of the presentation is taken also from that website. You can check it. And I would highly recommend you to start looking at the toolkits and the video resources, which you can actually use immediately. It's quite practical. It's not like, it's not very theoretical. It's actually quite practical. For example, on the business impact analysis template, I think this is a simple template that you can use. There are also the crisis management plan template. I've seen it. Again, there is no rocket science to these templates, but it does give you the clarity on where to start and how to put a frame on starting this process, right? So highly recommend you to look at the the toolkits. So all in all, at the end of the day, again, it's not as sexy as the tariff topic. It's not as exciting as the gold investment, but it is there. It is impacting our lives. Sometimes we just kind of take it for granted mostly, unless we're the one impacted directly. But what I can say for sure is that whether that's in my previous organization or in my current organization, in my current company that I work for, the climate risks are very, very, very real. So let me close it with a few examples. I did mention about the sardine business, which basically dwindling supply from local, and the fact that 70% is actually imported from Turkey, from Spain, or whatever. And secondly, I did mention and share about the mining business, which is also impacted by the climate change. Just now, I spoke with the GM, with the CEO of the mining business, and he was mentioning that in the month of May, they dropped the production of about, I think, 20% of their average normally, just because of the rainfall. But on the other hand, our plantation business, we are the largest exporter for pineapple, canned pineapple in the world, in Gunung Sewu. We have a large plantation site in Lampung, and there are some years where we got hit by the long drought very severely, right? So, fun fact trivia: how long does it take for pineapple to grow until it's ready to harvest? Does anyone know? It's actually pretty long. It's 18 months. From the land prep, from the planting to the actual harvest is 18 months. And if you do not identify the climate risk early, let's say, to manage a 30,000 hectares of plantation, right? So just imagine that 30,000 hectares of plantation. You rely on a lot of people, like a lot of labor. And this labor, basically, they might join the company yesterday, last week, 2 weeks ago, last month, or 10 years or 15 years. Whether that's 15 years in the job or just last month joining, actually, they might rely on certain habits that they learned before, right? So, okay, let's say I need to put this much water in the early stage of planting, and this is what I'm going to do for the rest of my life. But the fact that the climate is changing, right, actually requires you to do things differently. For example, one, the land prep needs to be more than the usual, for example, because let's say if it's very dry, then the water won't be able to seep down to the roots. The roots won't be able to absorb the water. So you need better land prep management, not like the usual when the weather is good. And secondly, also the amount of water, the amount of fertilizer, the amount of pesticide that you use, you cannot always refer to the SOP that you have, because the SOP is based on certain conditions when the weather is good. But when the weather is not good, then it's a different story. So imagine that if we ignore these facts, I think it's quite easy to say that more than half of your profit of the year can be wiped out because you ignore the fact that climate is changing. It's not static, right? So all in all, I think my main message is that the risks are there, but also the opportunity, right? The risks are there, but also the opportunity. So start early as possible. Use the toolkit that we have, and hopefully, by the end of the day, you will be able to build a resilient organization. And not only that, hopefully, you will be also to become one of the agent of change, the transformational agent in building a resilient economy. That's it. Thank you.
So, Mr. Johannes, I think your presentation is very useful and relevant for us, the attendees.
Thank you. My name is Theo from the telco industry. Now, my main concern is we understand that ESG would provide costs, and additional costs to maintain it. However, are there any opportunities for revenue side in our hope of adopting it?
Thank you for the question. I think it depends, right? What I mentioned is that opportunities will be there. It depends on industry that you're in. I'm not sure if it's telco specifically, but just imagine if you are able to make sure that you have a more resilient infrastructure that is typhoon proof, hurricane proof, probably. There's also one case study in the website if you check it, right? There's one case study in the Caribbean case study. So in the Caribbean case study, I think they also face a lot of hurricanes, typhoons, floods, and etc. Their economy is more than 13% in tourism, right? So one of the, let's say, the climate adaptation and the resilience effort that they put in is actually in building better quality, more resilient infrastructure compared to the normal specs of infrastructure that you will build anywhere else, right? So it may not be direct. For example, let's say in the example of telco and services, it might be your reliability, right? So let's say compared to your number 2, number 3 competitor, if you have your operation still running during hurricanes and storms, you know, it would create a great brand perception for you, turns to be more customer loyalty and etc., right? So that's an indirect way to do it. A more direct way would be, the easiest example would be in FMCG industry actually, right? So I don't know if you launch a, like probably, let's say the ones that are already existing today, the organic vegetables you see in supermarkets, which cost twice more or 3 times more than the normal vegetables. Less pesticide, etc., right? So people are willing to pay. I think the most important fact is that there are groups of people that are willing to pay, that are concerned, that are aware of these issues. So definitely there will be more opportunity, which hopefully can compensate your investments also in preparing for the climate change. Yeah.
I'm Ardo from IPM Institute, and this is my question. I just ran a research on ESG, the impact of ESG, economic, social, and governance. And I know climate change is one of the I think it's included in E, right? Mm. And then I found, and I do like a regression model, ESG score I got from Refinitiv database, and I regress ESG as a factor that determines or affects profitability, which is measured by ROE, return on equity, and I found positive impact. So ESG score positively impact ROE, and I treat ROE as like a accounting-based measurement because you can find in the balance sheet and then calculate rationalize it, right? And then I also regress ESG score on another measurement. I call it market-based measurement, like a Tobin's Q, like PBV, something like that, and also positively affect the Tobin's Q. And then my sample is Indonesian listed companies that are listed on the ESG index, something like that. So I can explain how ESG score affect the Tobin skew, because it will affect the market expectation, and that's why investors would willing to appreciate more the companies with a good ESG, something like that. But I still challenging to explain how ESG affect the ROE, meaning so it increase the profitability. And you mentioned with your survey that it can investing in a what do you call it, climate change resilience model will save costs, right? So perhaps can be alternative for me to explain. But do you have any alternatives to explain how ESG score increase companies' profitability, especially in Indonesia? Thank you.
Thank you. Thank you very much for the question. It's very, very interesting. Disclaimer though, I'm not a researcher, so my answer is based on hypothesis, based on my years of experience, right? So I think, and do correct me if I'm wrong, it's not a causal effect of ESG score and profitability. So meaning that having ESG score does not cause better profitability. However, I think it's correlated. Meaning, companies who have good ESG score is an indicator that the company is more mature compared to the competitors. More mature in what way? I mean, just imagine if you're running or if you're working in a company that has to firefight every day, that does not have good governance, right? That everything is based on the decision of the weather of the day or what you eat this morning. That is just an indication that the company is probably not well organized. Well, companies who have the time to actually think about sustainability, there's a higher probability that it is more well organized, both from organization structure or even also from the vision of the founders or the owners of the company, right? So that is my hypothesis. I'm sorry, I don't have data to back it up, but I think my intuition tells me that it is not cause and effect, but it's correlation. All right. Thank you so much.
My name is Nur from ACCA Securitas, and I want to ask about how any institution like ESG implement, because I think I have read some of the news or whatever, the institutional of the US have implement ESG more deeply, and the outside of the US not so well developed. So what is the view of the emerging, because it's so lately from even the developed market like US, and also US have been exit from the Paris Agreement. So that's what is the future of the outlook of ESG? Thank you.
Okay, thank you for the question. I think first thing first, we need to be aware that there's a term called the greenwashing, right? So I don't know if you're familiar with that, but basically greenwashing is a phenomena where companies tend to exaggerate the ESG achievements, right? There is questionable reliability of the ESG reports. It happens in many companies, including US. So I think there's let's say, more and more effort into governing the standards. Hence, the ISSB actually is released a new standard, right? S1 and S2, which the IFRS S1 and S2, which will be implemented as well in Indonesia, by the way, in the next 2 years, I think. It will come soon, by the way. So the regulation will be there. In terms of the disclosures on, not just on ESG, like carbon footprint and all that, right? So the standard will not only mandate companies to report, like the carbon footprint, the waste, etc., but it also has interesting questions there regarding the climate resilience as well. So in the events of climate change, what will happen to your business? So there are those questions included in the standards. So I think it's an interesting topic to talk about. I'm still also not yet certified in that subject, but it's an up and coming, aside from AI, which is a very hot topic today. I think sustainability is another one that in the next couple of years will be in high demand because the regulations will be there, right? So again, in making this work, we need both the government and the private sector to work together. It cannot be just the government or regulators, but also the private sector. So I think that's probably all I can say for now. Whether the future is gonna be bleak because US walked out of Paris Agreement, I don't think so. I think somehow we will make it better because the threats and the risks are very, very real. And and I think we will have to work together. There's still a lot of homework, right? So don't put yourself as a bystander and waiting for the result, but it's all of us in this together to make it happen. Thank you.
Thank you, Mr. Johannes. Please give Mr. Johannes a big round of applause. Before we conclude today's event, let us hear the closing remarks from Mr. Andrew Lim, Portfolio Head of ACCA Maritime Southeast Asia. Before that, allow me to first read a brief profile of Mr. Andrew Lim. Mr. Andrew is at the helm of the diverse portfolio that spans Malaysia, Indonesia, Brunei, and the Philippines. His leadership is characterized by a focus on critical strategic priorities, leveraging borderless ways of working, a digital-first approach, and fostering repeatable and scalable innovation. His passion for sustainability is evident in his efforts to ensure the long-term viability of ACCA in the maritime Southeast Asia region. Andrew collaborates closely with regulators, government bodies, and educational institutions to drive sustainable practices and initiatives. Prior to joining ACCA, Andrew dedicated over 20 years to the education sector, where he honed his expertise in strategic planning, business development, marketing, sales, and product branding. His extensive experience and commitment to sustainability ensures the advancement of ACCA's mission in the region. Please welcome Mr. Andrew Lim.
Thank you very much. Good evening, ladies and gentlemen. I'm sure you are glad to hear my voice as the final concluding remarks for today. So just for clarity, the portfolio I handle is a portfolio of markets and not a portfolio of shares or equity or commodities. Yeah. So I manage 4 markets of ACCA, which is forms the pillar of ASEAN, with Indonesia being one of the largest economy in ASEAN, and therefore with ACCA and supporting the agenda of the nation to produce finance professionals and accountants for the country, for the market, to support all efforts. So it's time for me to bring this event to a conclusion, but before I do that, I'd like to thank all of you in the audience for staying in the last 4 hours listening to those very interesting insights, part of buying gold, right? And the sharing, of course, by Pak Johannes on climate finance. And on that note, I would like to thank our guests from CFA Society Indonesia, especially Deputy President Pak Triono. Thank you so much for the support. I'm sure you know ACCA has a global partnership with CFA, and similar events like this are happening globally, whether it's in Singapore, in Malaysia. We have our society in Malaysia, in Thailand, and different parts of the world. And all of us are discussing intellectual discourse on different areas where we can improve. And both ACCA and CFA, we have a joint certification in climate finance, just in case you'd like to find out more. It's available on the website. But if you like some discounts, you can ask Ibu Julia, she can get you some discounts on that. A note of congratulations to our colleagues from the CFA Society and of course our ACCA members, our stakeholders, for creating such a powerful and impactful partnership here in Indonesia. And I'd like to draw a little bit on what Pak Johannes has shared and mentioned just now. So what he's shared just now is actually from one of our PI reports, our Professional Insights report, which is available on our website. And very interesting questions from the two Bapak on sustainability, ESG, and the Scope 1 and Scope 2, which is rightly said by Pak Johannes, will be implemented. And those are available on our website. So, ladies and gentlemen, as you know, I think in the past 20, 30 years, the planet has increased the temperature by 0.5 degrees. And what is the result of 0.5 degrees? You get rising sea levels. That's where all your tuna went, swam elsewhere. You have the ocean warming, and you know the ocean is a source of food for many of, fishes and whatnot. We've seen extreme weather conditions, the flooding in Bekasi, where I live, in Subang Jaya, in Malaysia, in Kuala Lumpur. It has never flooded before in my entire life. And that part of where I live is actually quite high. So if that part starts to flood, I think the whole Malaysia will tenggelam already, right? So it's very real. And just before I flew into Indonesia this morning, it rained very heavily and it was a drought for the last 5 days. And I don't know what happened. Temperatures have soared up to like 38, 39, 40 degrees, which is very weird at this time of the year. So climate is real. It's real and it's happening. And how does organization play their part for people, for planet, and for profit? And together with CFA, we have raised our voice, of course, for greater commitment of climate awareness in terms of businesses. And we have brought all these critical issues as the top of the agenda for policy makers. So 2 years down the road is implementation of Scope 1 and Scope 2 in Indonesia. Malaysia is happening soon, based on the National Sustainability Reporting Framework which will be implemented very, very soon. And there's so much more to come as our alliance, of course, with CFA grows from strength to strength. And basically, climate finance it's an idea where it's everywhere, right? It's throughout the world, and we have to play our full part in making sure the way in which businesses operate takes care of the health of the planet and the people, just as important as profit, as I mentioned just now. And climate emergencies. Again, Pak Johannes has shared a lot of examples about how it impacts production. What I have to say and what I remember from the reports that ACCA produced in terms of the researches that we have done, it may not be a direct impact to services or telcos, but it is basically the entire chain of supply that impacts the entire economy. If one does not do well, it's just like, I think the earlier example, gold prices, buying shares, buying stocks from gold-producing companies. If the entire economy does not do well, I don't think the company will do well as well, right? So just to highlight that, But from ACCA's point of view, we will continue, of course, to advocate for sustainable business futures, which is why we have our professional diploma in sustainability, and that looks at the aspect of sustainability reporting, basically the corporate reporting. And it guides our entire strategy, our education, and our research in the public space. So the report that Pak Johannes mentioned just now is Weathering the Storm, Building Resilience Against Climate Disruptions. You can go to the ACCA website, download the report and have a look, because that is done in consultation with all our stakeholders, members, corporate leaders, students, universities, everyone. So everyone has their inputs in there. So by championing transparency, of course, again, in emission targets and transition plans, finance professionals that is in the country today plays a critical role in reducing carbon footprints and, of course, net zero goals, right? And this is in supporting a fair, inclusive, and climate resilient future. So again, the reports, I won't repeat some of it, but what's interesting is in the report, it says 25% of this organization does not have a mechanism placed to build resilience at all, which means they have no plan. What happens if somewhere is flooded, right? And if you are growing pineapples, right? so that's the example. This is why ACCA and CFA, we are eager to sound this alarm to make organizations understand that they have to make sure that climate is a priority. Again, rising temperatures, I think more intense rainfall, all this evidence that I've mentioned earlier, it's now very real. And I know together with all these issues, we'll be able to solve this, and I'm confident that all of us will make our parts, our responsibilities to ensure that we do the right things for our future generation. So with that, thank you so much for your attention, and to CFA, to all the panelists, very insightful. I go back, bye go now. Thank you so much for having ACCA as a supporting partner, and have a great day ahead. Thank you.
Thank you, Mr. Andrew, for your helpful closing remarks. Please stay on stage, please, Mr. Andrew. Mr. Triyono, would you please come on stage to provide the present token of appreciation? We have reached the end of our event. Thank you to all speakers, panelists, and moderators for sharing their valuable insights and inspiring perspective today. Thank you to our sponsor, ACCA Indonesia, Agrodana Futures, Ashmore Asset Management, PT DBS Vickers Securitas Indonesia. And thank you to all the volunteers for all the help and support, and for making his event success. Thank you to all volunteer, Bapak Rahmat Sugiono, CFA, Executive Director of CFA Society Indonesia, and Ibu Dewi Murianti, Administrator of CFA Society Indonesia. Ladies and gentlemen, thank you for being part of today's event.